Today's February 12th, 2019, and this is SMB's weekly Options Tribe webinar. For those of you attending an Options Tribe meeting for the first time, we meet every Tuesday at 4:30 p.m. Eastern. And the purpose of the Options Tribe is to bring options trading experts from all over the world to our community each week in order to help you to improve your skills as an options trader. I do want to point out that SMB Training is not a broker-dealer. We're doing these webinars for educational purposes only. Today's webinar, any positions you see are going to be hypothetical. They're generated by a computer modeling software, and so they're going to be mid-prices that will appear, and that those will affect the P&L, so forth. And I just want you to know that those are not subject to the market forces of liquidity, slippage, and commissions. I also want to point out that options trading is risky, and your online broker has a document which explains those risks. Please don't expose any of your capital to options trading unless you fully understand the risks of options trading. When you first get started, please don't trade with any capital at all. Instead, backtest and paper trade. And if you decide to expose your capital to options trading, do so at a very small level, particularly when you get started, because you're going to be getting used to the way options react to the market. And until that point, you don't want to have a lot of capital exposed. So with that, I would like to welcome back to the Options Tribe, John Locke, who's been here many, many times. He's on our options trading desk. He has designed multitudes of options trading strategies. And in my opinion, he's one of the greatest options traders in the world, in my humble opinion. And John is going to be reviewing today the Bearish Butterfly Strategy, which was really the first of the many advanced courses that SMB's Options Tribe has sponsored over the years. And it's still one of my favorites. It's always been one of my favorite strategies. I know that it's the same for John and many, many other members of our community because it's just so powerful and it applies to, just so many conditions. It's an incredible strategy. So rather than hear me extol it, why don't we let John jump in and make his presentation about the Bearish Butterfly.
Welcome, everybody. Thanks for joining Seth and I here today. And I'm going to talk about the Bearish Butterfly. And we've already gone over the disclaimer material. It's essentially the same thing. And for those of you who don't know me, my name's John Locke. I have lockingyoursuccess.com. And I'm also a trader on the desk here at SMB. I'm a trading performance coach, wealth coach, success coach. We design trading strategies. We enhance trading performance through success and trading psychology. We've helped people build wealth, and we help people with business skills for retail and professional traders. The strategy that we're talking about today, something that I came up with actually fairly early in my trading career, back around 2006, 2007. And I've been teaching it for, over 12 years now. And it's been live traded in the markets for over 12 years, and it's one of the strategies that we track on our Monday Options Trading for Income webinar on Monday mornings, and we've been doing that since 2011, which is essentially when the SMB program came out with the strategy. And it's just a fantastic strategy. It can be used as a monthly income strategy. That's the way that it's taught. It can also be used with market timing to increase returns or to hedge long positions as well. For performance, we have a website link you can go to. It shows us your yearly performance since 2011, since we've been tracking them on the Options Trading for Income weekly update. So, and if you have any questions, you can contact us through that. All right, so some common uses for the Bearish Butterfly strategy would be it's taught as a monthly non-subjective positive theta strategy. It can also be, or it's been utilized by a lot of people as an opportunistic bearish bias, high probability strategy in markets that are overextended to the upside and likely to run sideways. It's a good alternative if you're going to do a bearish vertical. You get more range, you can make more money on your position. And it can be a hedge on bullish positions if it's sized appropriately to that bullish position. And again, especially if the market's overextended. So what I'm going to do is I'll give you a general overview of how things work. And, from there we can, we'll go over some trades. I'll give out as much information as I can in the time that I have. And if you want more, then Seth is going to tell you how to do that afterwards. So This is a strategy that's entered essentially 56 days to expiration, so there is an overlapping component to it. You could have two trades running at the same time. We'd like to exit at 21 days to expiration, but sometimes it goes in further than that. And it has a fairly high profit target. We have this thing called planned capital. Not everybody uses that. But planned capital for us means that it's the amount of money that pretty much the maximum amount of money we're going to get in the trade most of the time. Occasionally it will go over that number, but most of the time it's under that number, and it's under planned capital. And you'll see in some of the trades it doesn't even get near the planned capital number. So our profit target is 30% of our planned capital, so that's going to be a consistent dollar number. We have a lowered profit target because we'd like to be out of this 21 days to expiration of 10%. Another time we'll take a 10% profit target, generally is if we're only 1/3 entered. So this is a scaling trade that enters in thirds, and we'll show you how that's done as we go along. Our maximum acceptable loss is going to be 30% of our planned capital number. So if you're going to do a strategy like this, we have a minimal capital is going to be about $5,000. If you want to consider, if you're going to be overlapping the trade, it's good to have $10,000. The demonstrations are going to be using $50,000. Of course, whatever size you're going to use, you want to make sure that your max loss, you sized your max loss, and make sure that the max loss number is appropriate for you. So that is just a very quick description of the parameters that we're using. And the best way to show you this is kind of with examples. So I'm going to, we had a nice down move at the end of last year. And we do a webinar on the bearish butterflies pretty much every year, right, Seth? And
yes, that's right.
Pretty much over the last 6, 7, 8, 9 years, we're always dealing with up markets.
Yep.
We don't have a lot of down markets, but we actually had some down markets. So I said this is going to be really cool. So we can go over essentially the last quarter of last year, October, November, December, and January expiration of this year. We'll see how far we get. But this shows how it reacts actually to a down move. So let's, I'm just going to throw up an option view here. We do use option view analytical software for this particular strategy. And essentially the way it starts out is we go like 20 to 30 points behind the market. We put on a butterfly, a standard butterfly position that's about 20 to 30 points under the money. We generally start on about 56 days to expiration. And we have a rollback strategy, essentially, if the market comes down, and we have a scaling in strategy. We scale in thirds as the market goes up. So as the market goes up, we'll add another butterfly in here at 1720. We'll buy out another one here at 1740. Then we're fully scaled in. And then we have a rolling sequence that we use to stay up with the market if the market continues to go higher. That's essentially the way the trade is set up. Now, this position here starts with what we call a 10 lot, so it's 10 butterflies. And you can see they're about $10 a piece. And that gives us a total risk at this point in the trade of about $10,000. We have a $50,000 planned capital, right? So if we have to get fully scaled in, we have to do some rolls. There's a decent chance we'll get to $50,000 or so. Sometimes that's not required. Sometimes it is. The wonderful thing about this strategy is if the market comes down and it really starts crashing down, you're going to actually be pulling money out of the trade as you roll back. And you can actually be in the position with virtually no capital invested, which you'll see some of that in these down moves. Mm-hmm. So I just started with this one because this one's really easy. There was really nothing to do here. October or August of 2018, we had essentially a very flat market that just kind of drifted down a little bit. And it put us in a situation where we didn't need to do anything to the trade. So that's a trade like this might happen, 1 to 2 times a year. Sometimes it doesn't happen at all. Sometimes it's 2 times. Sometimes it'll happen 3 times a year in strange years. But this thing ended up just sitting here. And, if you look at the price chart, well, what it's doing since entry is just kind of flatlined on us, right? It kind of flatlined and ran sideways. So I'm just going to run through this pretty much to the end here, and then we'll get into something more interesting in the next cycle when the market actually starts dropping. So here we are, 24 days to expiration. We're in 1/3. We're up $8,000. If we go to I think we go to the Friday, or if we go to the Friday, we're 21 days to expiration. We have a profit target of a high profit target of 30% planned capital, which is $15,000. We are willing to take it off at $10,000 because we have a single position on. And when we're 21 days to expiration, we're actually willing to take off at $5,000 because we want to get out of the position. Our gamma tends to get high close to expiration. So this here meets all those criteria. And if you were to look at the analyze screen, we have $10,000 or $11,000 in the trade. We have a $10,000 or $11,000 profit. That's 100% on what we have in the trade, but we do have the capital set aside. So let's go into, so what's going to be happening here is at one point this November cycle got 56 days to expiration. We entered our next trade. So if we go back to, or if we go to our November trade, we actually ended up entering this at the 1690 short strikes. There have been no adjustments to this one either. It's up about $600 at this point, and the price chart, the market is, it's just been drifting down a little bit, but it's going to, as we know, it's going to start falling apart if you remember the end of last year. So I'm just going to shoot down. Actually, let me go to, why don't I do this because it makes it easier. Then we can cover more things because you can see the analyze chart at the same time. I'll pull this out. And of course, if you have any questions, feel free to ask away here. Mm-hmm. So this is our position. This has an adjustment when you start getting about under 1650. Now, some traders are concerned that a butterfly is a negative vega trade, and if the volatility goes up, it's going to lose money. But as you can see, that's really not the case here. There are situations where we can lose money if the volatility goes up, but generally, unless we're fully scaled in and in the center of the position, it generally doesn't happen. You can see we've had a substantial down move. We can see we're up about 5,400. We're not quite to an adjustment point yet. There's really not a whole lot of danger here. We're just in the center of the T+0 line. We're relatively flat delta, right? Not a big deal. If I move to the following day here, we get a bounce. If we don't hit down, okay. So now we are, we've come down 25 points. We're actually at an adjustment area here. We're below the actual adjustment point in this situation is going to be 1650. So we're underneath our 1650 number. So we're going to do a rollback here, and we just basically take the position and we're just going to roll it back at the money. And if it goes up too far, we'll start a scaling procedure. If it goes down, down to, let's see, in this case, 1610. Then we'll roll it back again. And the market more or less kind of fell apart from this point, and it went down.
It started, the sell-off started in October.
Okay, yeah, we're October 10th now, right? So here we have a position where we had a 34-point down move. You can see we get a nice pop in T+0. We're way below even the long strike, right? Our adjustment point here was 1610. We're all the way down to 1587, so about 23 points underneath our adjustment point here. So we take this and we roll it back again, and that's essentially what you do on the down moves. So I think we have an adjustment almost every day because the markets, it really started coming down. Not that day, but a couple days. There was another one here. We have the adjustment points actually at 1550 or 1543. So we have rolling it back to at the money again. You can see that if you start out in this positioning and the market drops, you can pretty much take it to zero and not get into too much trouble. So that's what I like about this strategy in this environment. It works very good in this environment. The other environment it works good in is fairly wide sideways chop. It works really well in that too. So let's go a couple more days. Okay. I should go one more day first. Right. So now the market starts to bounce. So we have the reversal, and really nothing to do here. What we have is we have our short strikes at 1540. We're going to start scaling this thing in at 1580. So if we come to Tuesday, right, we exceed our 1580 number. We scale in to our second third. And we'll see, I'll give this a couple more days. Right, then it starts to pull back again, which is why we like the choppy environment. We get into our second and third thirds. I like getting into our second, third thirds. And I don't know if this one gets pushed back to the downside or not, but you'll see. Looks like we're going to hit 21 days to expiration roll. Okay, so here we go. We had a nice hard down move here. So you can see we got scaled in 2/3. And if we go the day before this, this is what we look like. We're looking pretty nice. Most of the time, this is a profit target scenario for us. Most of the time, when we get scaled in 2/3 like this, and we get a market pullback, a lot of the times we'll hit our high profit target of 15,000. But we had a situation here where we just blew out the backside, right? We pulled back into 1533, and then we had a 46-point down move, which is about as large as they get in the Russell. They don't get a whole lot larger than that on the following day. And that put us way back here. Okay. We're still doing okay. We're up 7,500. But even if I pulled off this one butterfly, what we do on the downside when this happens is usually we'll get to pull off this one butterfly and go into 1/3. And then we'll be trading with 1/3 of position. But this blew not only past that adjustment, but it blew past the next adjustment also. So we end up doing a rollback. So we just pull the position and end up rolling back once again to at the money. So we have a position that was like this. I mean, notice the amount of capital in the trade, by the way. All right, it's like $2,500. So let's move, I think, 2 more days. Okay, now we had a 37-point gain here. We're up 89. We haven't quite hit our next add point. And the following day, we actually hit our 21-day to expiration lowered profit target here. We're willing to exit at $5,000, 21 days to expiration. So here we are, right? So we pulled this off. And that was the month of November expiration. If we were doing this at the same time, we have the December, which started this day, actually, right? 56 days to expiration. So in this case, we didn't have to overlap at all. If we have to pull our other strategy under 21 days, a lot of times we have to overlap. If we get out at 21 days, sometimes it overlaps, sometimes it doesn't. And let's just go to our December position here. And this is how our December position starts. And I'm going to widen this out a little bit. It's at $20, which is gives us a little better view of what's going on. So you can see to the downside, we don't really have any issues at all. But I think we actually had a fairly significant bounce here. So this will, or it may have been January. I'm not sure. Let me see where this goes here. Right, we had a interesting, a bad entry. So, one of the things that happens sometimes with options trades is you can get a bad entry, particularly when volatility is all over the place. So we ended up entering with, $200 down on the following day. We got a depression in value. We really didn't get much of a market movement, but we got a fairly significant depression in value, which happens from time to time, unfortunately. But that's okay. Right now we go up 23. And we're actually at an add point here. You could add, you might not add. It's we're really not in a hurry, in other words, to add to these positions necessarily. So particularly in a high volatility environment, we like to get solidly past our add point, which we'll see if that happens the following day. It does, right? It's actually almost a benefit for you, unless the market comes back right away. It's a benefit for you to wait to add. So a lot of these adjustments aren't urgent unless you start getting into your rolling sequence. They start to become a little bit urgent. But as you can see, the downside adjustments weren't that urgent. This upside adjustment also isn't all that urgent. We had an add at 1500. We have another add at 1520. But again, I'm just taking my time here. I want to be solidly over 1520 before I hit my add point. So right, we had a 33-point move the up the next day. So now we have had a substantial up move. We were back here at 1480 spikes. We were due to add in the 1500 when the market got to 1520, but it exceeded that point. And we start to do a rolling sequence at that point. So instead of just adding, we actually add and roll. So I come out here and I end up in this price movement puts me in this position. It brings me from the 1460, 1480 up into the 1500, 1520, 1540, and looking like this. And the maximum drawdown here is 15,000. We currently have about 25,000 in the trade about. We're down now about $22.5, $2,250. And that's typical for, when you get an up move, you usually get drawn down some. So let's see where we sit from here. All right, we're just sitting here. We had another adjustment here. We exceeded another add point or another roll point. So you can see we're starting to roll a little bit closer, a little bit more on top of the marketplace as we do this. So we're just going to take this 1500, going to roll it up to 1560. And we come into a position that looks like this. And all right, we go another 24 points. So this is a really large move. I think if we look at our price chart, right, this is where we got caught right here in a fairly substantial up move. We end up doing another roll. Actually, it's a couple rolls, right? It was a large up move. So we actually went from 1520, 1540, 1560, all the way up to 1560, 1580, 1600. We're essentially in the center of our position now.
So you had a double move on this day?
Yeah. Double.
I remember this day. Yeah. This is a great example of the bearish butterfly. This one.
It really is, because we have a really big up move, and not only that, I think we get blown off. We get blown out to the downside on the reversal.
Mm-hmm.
So I have to fix this foolish thing again here. My side by side. So this really shows. It really shows coming up and getting fully scaled in, and then reversing back out. I'm going to go $10. So we're down about 5,000, not too bad. Now we can't get away with this kind of a move in low volatility because the volatility skews aren't good. But in high volatility, we can get a really substantial move against the position without having too much trouble. So see if we get more up moves. No, we're coming down. Right, we just barely hit the roll too. It would have been nice if we didn't get back into this last roll with the reversal. So here we go, coming back. All right, so we came back and we ended up pushing to the outside of the tent on this reversal. And we are actually past, so first, normally, if the market's moving a little slower, we take this one off first. And then if we're past this point here in the pink, we take the next one off. But a lot of times you're only going to be doing one of these at a time. But this is, actually it's pretty rare to get fully scaled in and then blown up back to the downside. And then we have our last third, which, I wonder if I made an error on this. This actually doesn't get rolled back till 1520. Did I end up rolling that back? Oh, no, I didn't. Okay, yeah, so we didn't get rolled back yet. So we end up having to pull out of the upper 2/3. Am I out? And we're in this position here. And excuse me for a second. Need a bit of a drink of water here. And yeah, so here we are. We have a rollback point at 1520 at this point. And this is what the price did, right? We chased it all the way up, and now we're getting hammered back onto the downside.
Mm-hmm.
And I guess I can't do that because it goofs up my charts, doesn't it? Okay. So, gotta love option view. Okay. All right, so I'll try not to show the chart again so this doesn't happen. So anyway, this is where we're at. We go into the next day. We end up hitting our rollback point. We roll this back to at the money. And we'll give us a few more days here. Bit of a bounce. $27. Oh, okay, so we hit another rollback. Right, look at the capital in the position here. We're under $3,000 now. We're at, well, I don't know, not very much here after the rollback. So you can see, like I said, it's really nice on down moves here. Bit of a bounce. And I think we hit the $10,000 number here. Yeah, we hit the $10,000 in 1/3 of a position, which I'm generally going to pull it in that case. So that's that trade, right? And that is the end of that one. Had we stayed in, we did have a nice bounce. So a little bit of lucky timing here, or just being reasonable with your profit target is really helping us, because this is right before the fairly large rally that we had coming into the beginning of the year. Although it didn't get really hard until the 24th of December, 25th of December.
Right, but right after Christmas, yeah.
Yeah. So anyway, that's the end of that trade. And then we have a January trade, which ended up getting drawn down pretty well. So
yeah, we've had a bunch of questions about how
sure.
January and February did. So you're going to do January, right?
Yeah, January did fine. February ended up coming out at a loss. February, we had a historic up move in the Russell, and I believe it's the largest up move we ever had in a 60-day period. So that's going to stop you out. So January here. Let me see. Start date would have been 56 days to expiration. So we'll just go with this here. We're 52 days to expiration. We've been in the trade for a couple of days. I don't know that there's been any adjustments yet. Not till the 28th. So here's what we look like in January, right? We had a scale in on this day here, which was November 28th. We have another scale in here, and we get drawn down, right? So This is a situation where we got drawn down a little bit, and we're down about $2,800. Normally, on a reversal here, you're going to be good. As a matter of fact, normally if we reverse here, under most circumstances, you're going to hit profit target. This ended up getting crushed down, I think, if I remember right. So we had a 65-point down move in the. This was the biggest down move we've ever had in the Russell in one day. From the day before, the biggest move we ever had. So we are getting some big moves. At this point, we're up $8,700. Everything looks nice. Realistically, if we would continue to drift back and have volatility drop, we'd be looking pretty good here. But we had a volatility crush, right? Volatility got really pushed down here. And this is where you are affected a little bit by volatility, not when you get pushed out the backside, though. So now we're getting pushed out. So we hit a adjustment point here where we have to drop out of our upper third. And we're looking like this. I mean, everything's going fairly well so far. Really not any big issues. Here we go. All right, so we ended up dropping out here to 1/3. We're back down to 1/3. I don't want to look at the price chart because, well, that goofs up our analytical graph, apparently. So now we end up actually doing a rollback. And this is one of the issues that made this trade a little bit problematic in this month, is because of the having to do a rollback, I think. December 14th. Oh, actually, no. I think what happened is we actually hit $10,000 here. I don't know. I don't remember. Let me see. We'll show you a losing trade in February if we have time. February, you just got crushed in February, went straight up. So, but you can see how far it actually lasted. That's the impressive part there. Let's see what day we actually got out of this thing. It's 32. Right? I think we had another rollback. Right. So 2 rollbacks there. I think it was the 24th, which this was a half day, but there were no adjustments. Then we had a 51-point up move here on Friday. This is the largest up move we ever had in history in the Russell, by the way. That should be a clue to you. The things may be going up.
Yes.
You get a record up move like that.
Yeah.
27th, we had a bit of a reprieve, and then here, the 28th, we get out at our reduced profit target number, which was, again, is where we want to be out. So that was that strategy. At the same time, we have our February. We have time. Yeah, we have some time for February.
Yes, although we have a bunch of questions.
All right, let's do some questions.
Yeah, why don't we try to get through those and see if we have time left?
Okay.
And we do, of course, have a special announcement. So,
of course, right.
All right. Paul is asking, what are your criteria for choosing the short and long strikes?
They're always 50 points. So the program is very regimented. It's always 50-point wing butterflies. It always starts 20 to 30 points under the money. And we scale in at 20-point intervals, and there's rolling things. So your shorts are always 20 points apart. Your longs or your wings are always 50 points. So it's always the same. Yep.
Okay. Dave Stewart's asking, why do you use the T plus 365 days on the analyze chart? This is more of an option view question, but that's all right.
I don't even know where he's referring to that.
Max projected date December 28th, 2019, maybe? See, it does say T plus 365 right here, but I'm not sure.
Yeah, typically I'm not using that. I mean, we're using this here.
Yeah, I guess maybe he may have asked that when you had that on the screen with no position on. Possibly.
Maybe.
Yeah.
And it may have popped up or shifted on its own. It's nothing that I've changed.
Okay. All right.
Yeah.
Paul Bunch has asked this a couple different ways, and that is, what are your thoughts on entering now, today? The market seems to be overbought, so I assume it would behave well.
It should, right? So, you always have to, if you're going to be subjective with these, right? So we have a lot of traders who are subjective with these. Normally when one trade has lost, I'm very interested in getting into the next month. And certainly if I have one trade that's lost and another trade that's drawn down, which is the situation right now, I'm very interested in entering a bearish butterfly, because at that point, in order for that to happen, and if the problem is been to the upside on both trades, in order for that to happen, the market's just terribly overextended. So generally that's going to be good, but you also want to think of how the trade's going to play out going into the future. So we are in an uptrending market. I think, like if you look at Thinkorswim, I think we have a fantastic entry point where you shouldn't really get into trouble to the upside, at least in the first phase of the trade. Mm-hmm. But what's going to happen, or what's likely to happen in the marketplace, is we're likely to come up and test the top of this cup here, and then we're likely to pull back and then probably go higher. So I think you got a fantastic entry here. It depends on how long you run sideways. At some point you're gonna start taking on some more upside risk, more than likely, if you're bullish in the marketplace. So as long as you're not longer term bullish, it's fine. Sometimes what we do in cases like this is we put a profit target on it. So we might enter here and allow this thing to pull back and range for a while, and then if it breaks out, we just exit at a profit, right? So there's ways of modifying the strategy, but yeah, if you're going to be subjective, it's a pretty darn safe entry point where you're not going to get blown out right away, but this could come back to bite you late in the trade with a as this resets and goes higher.
Okay. Yep. Right. So that was the question from Paul. Dr. Frank is asking, can Thinkorswim be used instead of OptionView? I assume he means for the analysis screen.
Yeah. Well, first of all, just a note to everybody is you really, before you do any strategy, you really need to spend extensive time backtesting it, so you understand how it reacts and what it does. So for that reason, we should have backtesting software. This does use delta theta guidelines that, put it this way, the analytical software is clearly different. Thinkorswim analytical software gives you clearly different Greek numbers. So you're going to have differences in months where you have delta theta, because there's delta theta rules and stuff in the trade, and you're going to clearly have differences in under those situations. Also, if you go into expiration guidelines, you have delta limits in the trade, and you might be hitting those, and that's going to be clear differences. So you'd have to expect differences, sometimes significant differences, in the way you're going to be positioned, which can affect you negatively or positively, depending on what the market does. The same thing if you go with O&E software, the projections are significantly different. So, and that's with any strategy. It's not just this one; it's any strategy you do.
All right. Dr. Frank goes on to ask, can it be used with futures options instead of indexed options? For example, ES instead of SPX.
Well, you don't want to do ES.
Right.
Right. We're using the Russell.
So you would go with RTY probably.
You'd have to do RTY, right? You wouldn't want to do, it's a different trade on a different index. So you have to realize that, again, with all your trades, they're different trades on different indexes. They move differently. So, and they've put different volatility structures. So you could theoretically do RTY. The volume is pretty low in RTY, though, keeping that in mind.
Mm-hmm.
Yeah.
Right. Okay. And Steve is asking, why is this trade and the M3 made mainly in the rut as opposed to SPX? Isn't SPX higher volume and more liquid, tighter spreads, less slippage, etc.?
Well, it's higher volume. As far as less slippage, I don't agree with that necessarily. Once you learn how to execute the Russell, you should be doing fairly well. And I've seen you're going to have times when execution is excellent, times when it's not, and so forth. But so in other words, we don't have a liquidity problem in the Russell. The bigger issue is the SPX moves a lot more than the Russell does. So a bearish butterfly strategy in the Russell, you can do the strategy, but you would want to do it as an opportunistic strategy, because the Russell might move 100 points up. Would be 100 120 points up is a pretty big move for the Russell. I mean, this is a historic move. We've never seen one this big, but that's a pretty big move for the Russell, but it's nothing for the SPX. So if you're going to take that strategy and just do it in the SPX, it's different. Also, the volatility structure in the SPX is a lot more variable than the volatility structure in the Russell. Sometimes the SPX is actually has a worse volatility structure in the Russell, even though it moves a lot more. Sometimes it's better. So, in both trades with the M3 we have an M3-ish trade in the SPX, and it's very different than the M3. So we have had people trade successfully in the SPX with the M3 with the guidelines that we have in the Russell, and you can do that. I would prefer not to do that. I prefer to do it in the Russell. Your reward for trading is better, and generally you're going to have better results in the Russell. Yeah.
Okay. Robert F. Asks, is the wing width ever changed regardless of marketplace volatility increases and wide market moves?
Nope. Always the same.
Okay. And it's been the same for 12 years, matter of fact.
It's been the same with the Russell at $350 and the Russell at $1,650. And volatility levels all over the place. Yeah.
We got another question. If this was traded since 2006, what was the return on investment on required minimum account size?
Well, you can go since I don't have information on the top of my head. We've done really well. We've had one losing year since 2006. That's 2016 with the strategy, and the returns generally are around 120% a year. But that's considering overlap. So if you cut that in half, it's about 50% a year. I'm not sure what the average is. You can go. I gave a website link, and that shows you yearly returns since 2011. But it runs in the 100% range. What about 120? I think which runs about 60% if you cut it in half for the overlap.
All right. We have another question. How do you find the execution during a high volatility market?
Generally pretty good. I like the execution in high volatility markets better than low volatility markets. The exception being there are exceptions. If you go to a complete extreme where, you have usually, in other words, if it's a high volatility market and it remains a high volatility market, usually your executions are pretty good. When you go from a very low volatility market to a high volatility market, right? So there's situations or time periods when executions really sucks. Usually that time period is in very low volatility environments. Is where we usually have execution problems. We don't tend to have execution problems in high volatility markets with butterflies. They're generally pretty good.
Okay. Do you use the true delta of option view? I assume he means in that settings.
I use these settings, right? So this is what I use for settings. We use a variable model, not the new variable, a regular variable model. And that's pretty much the settings that I have there.
True delta gamma. Okay.
Yeah.
And Steve, I'm guessing this is Steve Hammond. I'm not sure, but he popped into the chat the returns that John did from his website trades. Those are like back-tested trades, right, John, in your website?
Well, the website trades I call real-time simulated. So we're making real-time decisions.
Right.
Right. backtested is very different than real-time simulator, because backtesting, you can go back.
I mean, they're paper trades. That's really what I meant to
Right.
ask.
Yeah. They're paper trades, but they're real.
And you're trying to stick strictly to the trade guidelines in those website trades.
Yeah, in my live trading, a lot of times I am the type of person who does analyze the market, and I will modify my trade plan from month to month.
I see.
But in the website, when we do the options trading for income website, you'll hear me say often, I don't like this, and normally I would be out of this, but this is what the rules say, so we follow the rules. And yeah, the strategy by the guidelines is that's pretty much what it performs, and that's making, again, real-time decisions and not being manipulated after the fact. So.
Okay. Do you adjust during the market, or middle of the market day, or do you wait till the end of the day?
No. It would be extremely rare for me to adjust in the middle of the day. Normally, I will adjust in the middle of the day to take advantage of an opportunity. So, we get a move way past the adjustment point in the morning, and I'm expecting the market to continue down later on in the day. Sometimes I'll take advantage of like the midday bounce, like we do on some of the trade desk positions when it goes down.
Right.
But generally, I'm not going to. And in the Monday morning, I don't think I ever do, unless we're in expiration week. Expiration week, we do allow that, but for the most part, no, we're not doing anything midday.
Okay, and Tano is asking, if you had to hedge the rut to the upside along with this trade, how would you do it?
Well, it's going to be very situationally specific.
Mm-hmm.
That's in other words, if you want to trade this strategy and allow for more upside room, I'm assuming that's the question. You can. I think it's butterflies. You can do it. Yeah, you can do broken wing butterflies. Some traders do weekly bullish verticals at the money. We have a whole bunch of people do different things. Sometimes I'll push this into an M3. You push it into an M3 strategy. To the upside. So
a lot of people will. You make some money. You get up some money as the bearish butterfly, and then there's a kind of a chance it'll bounce. So you can roll into an M3, and if it keeps selling off further, the M3 can usually handle that. And if it doesn't, the M3 will handle the bearish would handle that situation pretty well if it were to bounce.
Right. If you get into M21, for example, the M21 program, we're always, we do an analysis of the market. We make a trade plan for that specific for a specific situation, and we'll be switching from a bearish butterfly to an M3, into a rock trade, back to a bearish butterfly, into an M3. The three strategies of rock, the bearish butterfly, and M3 are essentially made to be traded together.
We got another question. Will you take an opportunity to enter sometimes days 57 through 60, or do you stick to 56 days only?
Right. So within the program, we stick to 56 days only unless it's a holiday. Live market trading, I don't really care how many days to expiration it is. I just take maximum advantage of what I think is going to happen.
Mm-hmm. Yeah. Okay. All right. Well, I don't think we really have time to go over another example, and there is something I would like to announce. You know how October is Rocktoberfest. Can everyone see my desktop? It should say the Bearish Butterfly video series. Yeah, great. Yeah. So February is Bearish February, I guess, instead of Groundhog's Day. And
it's Groundhog Day.
Yeah, exactly. So let me tell you a little bit about this. Is an incredibly powerful strategy, as you can tell from the returns, and as you can tell from how many years it's been traded successfully by so many traders. And the trade line guidelines offer a high win rate in most market conditions and potential high returns in certain market conditions. It's a strategy that provides big profits. As you can see, it has a 30% maximum gain, or target profit, I should say, particularly in bearish, trending, volatile, and kind of chopping markets. It does really well. The systematic and objective way to appropriately size your trade is explained in this series, and you adjust your profit targets based on time and market conditions. And in the series, John teaches the once per day management method to adjust the bearish butterfly to change market conditions. So the course, here's what's in the course. There's trade guidelines. It starts out with trade guidelines. And so, that first session goes over it's unbelievably detailed. You can literally everything you can think of that can happen in the market. He describes how to respond to that in that session 1. So it's really critical. When I trade the butterfly, I just pull up session 1 and I use it literally as a trading manual. So I can refer to it in different circumstances. Then in session 2, we go over an average month. In session 3, we deal with, it gives examples of rallies. Session 4 is examples of a large sell-off. And then sessions 5, it deals with incremental adjustability. And session 6 deals with the bearish butterfly in an extremely bullish market. So that would be, for example, a good session to watch, in under these conditions that we're in right now. This series is in 6 parts, as I said. It's 479 slides, full trade plan details. When we first filmed this, I could not believe the amount of work John did to pull that thing together. It was incredible. And it's normally on sale for $12.75, but until February 27th, we really cut the price down to $9.50, which is, an extensive reduction. And so that's till February 27th. Now, if you will bear with me now, I want to read a couple reactions to this course from people who've taken it and or worked with John. And then if you listen to these very, very exciting comments, there will be yet another surprise announcement for you. So it's worth it. It's going to be worth your time. So I'm just going to read a few of these testimonials. This strategy is one of the best I've used. I got my money back in the very first month and have been successful and have had successful months since January, thanks to you and SMB from Rada. Appreciate your sharing the knowledge. This has completely turned around my options trading success. Keep up the great work. These are actual testimonies that we got in. Many thanks to you, John, Seth, and the Options Tribe for presenting this information, and many thanks to John for developing the trade and sharing it with the community. Let's go down to this one. Over the past 4 years, I've been trading, and as every beginner, I ran around in circles, wasting time and money. I had all the desire, but what I felt was really getting nowhere. It was like a light going on when I found John and his style of trading options. It's been the key to opening the door for my success and financial future. That's Chris from Australia. We've got people from all over the world. Let me read you just a couple more. His strategies work because he has such a good innate feel for the multidimensional interplay of price volatility in the Greeks. Very well said. John has the ability to take something very complex and make it accessible to the less experienced trader. The less experienced trader. John also works extensively with the all-important soft factors of psychology, emotions, and discipline. And then John is an innovator who's helped my trading immensely. I have found his methods and philosophies about trading to be life-changing. Since working with him for the first time in my life after years of trying, I've become a profitable trader. That pretty much says it all. Finally, I purchased this course for a couple reasons. I have a full-time job, so I cannot manage multiple trades of this type. So I'm thinking these strategies will work for my smaller accounts. Also, I think this is a great way to introduce my wife and 2 teenage kids into the options world without blowing them away. Thank you, Seth, SMB, and especially John. So this is a family affair now, John, isn't it? And
yeah, it is. Yes.
Yeah, it's a family affair. And I think what that trader meant by this is that this is a very detailed course. Literally everything is spelled out for you. It's almost rigid. It's just so absolutely detailed in terms of exactly what you do in exactly every circumstance. So that's good for people, especially people who are, just getting started trading. So the Bearish Butterfly series, as I mentioned, we've got it on sale for $9.50 until February 27th. However, here we go. Pretty fancy, right? If you decide to purchase the course by tomorrow night, this is February 13th, but tomorrow night at 8:95. So all you guys have to go out and get your wives Valentine's Day presents, and then make sure to leave in time up until midnight for you to buy the Bearish Butterfly strategy for only $8.95. But that $55 savings over our really great price anyway is only available until tomorrow night at midnight. Then it bumps back up to $9.50. And then on February 27th, it goes back to $12.75. So save, you can buy one of those giant, what do you think, for $55, John, can you get one of those giant hearts with the chocolates for your wife, right?
There you go, yeah.
Or your, whoever, you know, if we're ladies are on here for your husband, right? So, or your sweetheart, whoever it is, you got 55 extra bucks in your pocket if you act before tomorrow midnight. Right, John?
All right.
I should be on like, midnight television, right?
There you go.
I'm getting there. So anyway, order the Bearish Butterfly at bearishbutterfly.com, bearishbutterfly.com. That's how you get that tremendous price that we just mentioned. Also want to suggest that everybody join the Options Tribe. It's only $30 a month, and you get to see every recording that we've ever done. There's a zillion John Locke presentations over time. Somebody reminded me you were our first guest on the Options Tribe back in May of 2011. So that's right. That's how long ago we've been doing this. And so it's a great opportunity. And also John does his weekly trade review where he shows everybody the trade that he trades live with live capital on SMB's options trading desk. So that's a great opportunity for everyone as well. And you get to see all the recordings. You get 5% off of all Options Tribe products, meaning that if you bought the Bearish Butterfly today, you get another 5% off of all the prices that I just showed you. So it's very, very worthwhile. I want to thank John for his always tremendous presentation. I want to thank all of our attendees for attending today's webinar. Bearish Butterfly, even if you only do it on a small portion of your income, just think about those returns. If you just did this on a small portion of your account, which you may want to consider doing because it also has a 30% max loss. So you want to watch how much of your account you dedicate to this strategy. But long term, as those returns compound away, start doing the numbers. It gets pretty impressive. And so it's a tremendous strategy. And I really suggest that everybody take full advantage of that by going to bearishbutterfly.com. So, John, thank you. Thanks, everybody. Take care. Good night, everyone.